technical analysis tool these days are median lines. Our guest today is Tim Morge, probably the most preeminent expert in this area. Tim, thanks for being here.
Thanks, Tim. I appreciate it.
All right, Tim, so define median lines for us.
Okay, my earliest mentor was Dr. Alan Andrews, a thermodynamics professor from MIT. And his father owned a brokerage firm, and he always thought technical analysis was basically hooey. But he used to go to these Friday night dinner parties and hear these technical analysis people like W.D. Gann talk, and eventually kind of got dragged in, so he decided to do some research. He spent 4 years with graduate students at MIT at the mathematics department, and they took a look at Roger Babson's work, which is based on Sir Isaac Newton's theory, as above, so below, or for every action there's an equal and opposite reaction. And what they found was that if they use alternating pivots, a low, a high, and a low, and then connect the second and third pivot, the B and C pivot, bisect it, draw out a line that gives you the slope, then connect it to the low, connect it to the high, that gives you median lines. Some people call them pitchforks because they look, kind of like a fork. They're a leading indicator. They have a mathematical relationship that's derived directly from the pivots. And what's nice about it is it shows you where price should run out of energy to the downside and the upside, and you basically trade with them depending on the slope. So if they're downsloping, you'd be selling against the downsloping lines. And if they're upsloping, you'd be buying against the upsloping lines.
So it's kind of a form of channels?
Channels are a subset, absolutely. The difference between channels and median lines actually have a mathematical relationship. You can do the statistics that tell you when they're headed toward one of the lines, they'll make the line 80% of the time. Statistics are easy to do. Channels, they are a little more curve fit, and you have to be a little more careful about the conclusions you draw, but they're very, very similar.
All right, so traders always, of course, want it to just bounce exactly at that line and come back. What's close enough? How close do you want it to get it, or if it comes through and then comes back down? It's an art in that sense. This is
about 80% science and 20% art, in my opinion. It's always going to be that. I don't care. People go, the better computers are going to be, the better tech. No, I don't believe that. There's always going to be some art. I tend to use 10% as a rule, basically, especially when taking profits. If I have a profit target up at one of the lines, we get within about 10%, unless I'm completely out of my mind. And every once in a while, traders go out of their mind. I take my money and run. The 10% is close enough for jazz.
How about a stop loss? If you were trailing a stop, would it be 10% below or above the line?
No, it's not. No, I use market structure. So I'll use a prior major low, and if I'm long. And the reason why is that's where the buyers are at, the limit buyers, the big whales. People like me that trade hedge funds. Okay? We have our orders at prior swing lows. So I'll have my stop below that, and the limit buyers that didn't catch it before are now sitting at that prior swing low with all kinds of limit buy orders. I want to have my stop loss underneath that so that I at least have a better chance of that slowing down the move back through.
And you've got a website where you talk about this every day.
I do.
Where does somebody go? Give us the URL.
Oh, it's marketgeometry.com. It's simple.
And you also own Median Lines.
At medianline.com. It's all articles. Actually, it's all articles that we've done through Money Show. And you can see my articles at Money Show. And I thank you actually for talking to me and starting to write. We've well over 100 articles.
Tim, thanks for your time.
My pleasure.